Hello and welcome to the Financial Time Travelers podcast. This is episode 11. Excuse me, sir. Your bias is showing. Part 2. Part 2.
Who's in charge of the music?
Heinz, I watched the bobsled too. Yeah, man.
There it is.
Kiss the lucky egg.
I can't work without music.
You remember Cool Runnings? Oh, yeah.
Yeah, great movie.
Kiss the lucky egg.
I'll have to tell you one day about my soapbox derby career.
You had a career?
Yeah, 3 years running.
Wow.
Yeah, it was pretty
We
cool.
were just talking about earlier Cub Scouts, Pinewood Derby.
Oh,
Maybe
yeah, that
want
was
to get
awesome.
Caleb into it just so I can make a Pinewood car. Or we could like go to Goodwill, buy a Cub Scout outfit, and that way I can just sneak in and just be like, I want to race Pinewood Derby cars.
And you can save the $35 initiation fee.
Yes.
Wow.
And then also there's like the full size one, right?
Yeah.
The free. That's what you're talking about. The
Yeah,
soapbox
the Pine
cars.
Derby. Yeah. It used to be big. Akron, Ohio was the
Right.
championship, and you work your way around
Downhill.
the country. Right, big
It's the
deal.
beginning of Little Rascals.
Right.
It's the finale. It's the
Yeah.
very ending.
So we'll have to share my experience with my dad building a Pinewood Derby.
do you have pictures?
I
hope you do.
May or may not.
That'd be really cool.
Yeah.
Okay, so today we're getting into part 2.
What are we going to talk about today?
Your bias
Okay.
and how it's showing.
All right.
So, in episode 10, we went through the cognitive bias. Now, these are biases that present themselves and you think you're in control of the situation, but actually your brain is tricking you in how you're perceiving them and how they've been presented to you, where you're not in control of the situations if you're not aware of those particular cognitive bias. And a quick rundown would be the confirmation bias, gambler's fallacy, status quo bias, as well as the in-group bias and bandwagon effect. So if you miss those, make sure to go back and listen to episode 10, which is part 1. We're in part 2, so we're going to go
This would be
into...
like going back in time.
Yes.
Okay.
If you go back, this is actually going forward in time, right? Because episode 10, I'm just talking about chronological order here. We'll never know. It's the infinite theory.
Right. Cognitive bias. So you covered
it all.
You covered it all. So now we're going to talk about the emotional bias. So with the cognitive, that is where, candidly, your brain takes over.
Say, shut up, Nile. Walk it off.
Walk it off. The cognitive is where your brain sort of takes over, and you have these responses, and you have a conclusion.
I said that.
And you draw to that. The emotional is the other part of the brain.
Right. Makes you feel good.
Which you override almost logic, and you do what you want to feel like you're doing.
Absolutely.
It's a bias, and it has probably, in my opinion, a greater influence in how investors make decisions, and largely, in my opinion, why investors rarely make money as the amateurs.
This reminds me of a study.
Okay.
Remember, we talked about this when I was in my other office.
Okay.
When we first started doing pretend takes of we were thinking about doing a podcast. But we spoke about how that Wall Street Journal did a study on the portfolio managers, and the more credentials and more initials they have after the name, the more likely they are to double down. And it reminds me when you're making a bad and be wrong.
Right, because they're so confident.
Right. I have all these degrees. I have all these designations.
How could I be
I'm right.
wrong?
You're wrong.
Right.
And that goes into the overconfidence bias, which we'll get into. But that's a great example. And sorry, I forgot about that. And I thought it was really fun.
Yes.
Anyway, so getting into the first emotional bias that we wanted to cover.
But we need to lay the foundation here first.
Lay it down.
Okay, all right.
You're the mason here.
Yes. So what we're talking about here.
He's not a mason, by the way.
Yeah, but close.
Are you?
Well, I've done a lot of concrete work.
Oh, okay. The real mason.
Start
I
working
thought you were talking
in
about
construction when I'm
Freemasonry.
6,
That's that's capitalism masonry. We're talking about Freemasonry.
Okay.
Get back into it, Mr. Illuminitis.
So let's just tell the listeners why this is so clearly defined and the evidence is so broad. So everyone knows from the time that they were in kindergarten that in order to make money, you buy low and you sell high, right? Very simple. Buy something at
kindergarten
price minus. Yeah, well, for me.
Sounds like you're stretching.
Caleb, right, for sure. Caleb's teaching. He's now charging for seminars for
Class.
his kindergarten.
Yes.
After he
Frank William Agbagnale Jr.
Right. So, and we're going to be learning a lot more from Caleb, I think. So anyway, everyone knows that you buy low at a price, so X minus something, and you sell it at X, you make money, the differential, the beta, and you're profitable. Very simple. Mm-hmm. And you get a little more complicated because there's maybe some operating costs and but your cost is less than what you sell it for, you make a profit. So buy low, sell high. Very simple. Why can't people do this? and especially it's evident in the stock market.
Why can't professionals do this?
Right. So we won't. That's a different topic, actually.
It is a different topic.
But that's actually getting back to your credential problem and
Still
overconfidence.
the same result.
Right. But the emotional. This is the cycle that takes place. You're at a dinner party, and this was very evident during the 90s when we lived in Silicon Valley. Everybody was making money. Their companies were going public, and money was just flowing everywhere.
It was the best of times. It was the worst of times.
Exactly. And so what happened is that people were very excited about how excited everybody was, and what do you own, and we're doing fantastic, and AOL and all these companies that were just going
great
public,
investment,
right? Enron and etc. And so what do you want to do? You want to be part of this fun, this magic. You want to be part of this positive energy that's going on. So what are you going to do? You're going to buy some of the stock. I mean, they're owning stock. They're making money. It sounds great. Everybody's happy. They're high-fiving.
Not only that, but you're going to reduce your salary so you can take company stock as a piece of your compensation, right?
Well, it actually got worse. In the latter 90s, what they were doing is, why should we use our very valuable stock that's going up that everybody owns and having a great time? Why should we sell that to buy our house or take out a mortgage? What we'll do is we'll use the stock as capital, as collateral, right? Thank you very much.
You owe me a green smoothie.
We'll have to go over that in slow motion and see who won that word. But anyway, so use the stock as collateral to take out loans. Therefore, instead of putting up real money, we'll put up this paper money, which is your stock options.
Call it funny money.
Funny money. And we'll buy the house. Well, guess what? When the stock market crashed in 2000, that collateral, banks are calling up and say, by the way, that collateral, we need real money backing that. And now you don't have the real money. But my point is that in those exciting times, you want to be part of it. So you buy in.
And it all makes sense.
Right? How come?
Because everybody's doing it.
Right. Okay. So, but then what happens in 2000? The market starts selling off. Stocks are going down. Everyone is
at a rapid
no
rate.
more parties anymore. Remember those Halloween parties? And so anyway, so no more parties. People are getting upset. They're looking at their stock portfolios. They want to get rid of this pain. They don't want to keep seeing their statements and their accounts going down and down and down.
Right.
It's a bummer. You're coming home. You're driving home. You're feeling how terrible your stock portfolio, your 401k, everything is going down. Now you may have gotten your pink slip because the company can't pay their bills.
This is so depressing. Can
Horrible.
you get to the good part?
And so what do? You want to get rid of this pain. You want to get rid of this depression. So what are you going to do? You're going to sell those stocks.
Oh, jeez.
Right. So
much more rational than what I was thinking.
So yeah,
sell the stocks.
Yeah, we're just focusing. We're just focusing on the stock portfolio here, not everything else, right? So you
took me to a dark place.
You bought at a high time. It was exciting, high-fiving, great parties, and now you're selling at the low times.
Right.
That's all emotional driven. What we're going to do is we're going to unpack how you cannot be part of that cycle. But the point being is that this is what happens every day. You're reading a great article in the newspaper, you want to buy it. You're reading how terrible a stock is doing, you want to sell it if you happen to own it. And you continue buying high and selling low, buying high, selling low. And you wonder why after 5-10 years you haven't made any money. And it's because you're letting your emotion dictate your buying habits. In actuality, the worse you feel about something, the more it should be on your watch list as the right time to buy it. And that's another sequence. Again. The worse you feel about something, the more it should be on your watch list of something that you should be considering to buy.
Well, that sounds totally counterintuitive. So how do you lock that in? I would think that you would have to be aware of these things in order to be able to do them. Otherwise, your natural inclination is going to be incorrect. So why would I want to buy something when I hate it?
Yeah, and that's a great question. And what we'll talk about in subsequent episodes is how you take your watch list to becoming your buying list. But for now, back to your question, what you need to do is look at what's not being bought. Because in order to buy low, think about this. You want to buy that horrible house. You want to buy that company that's not doing well. You want to buy in that industry that's sucking, that's not doing great at all.
Yes.
Because you want to buy low. Why is it low?
Discount.
It makes obvious sense because no one wants it. If you have more supply than there is demand, price keeps going down until eventually it balances out to supply equals demand. So if you have more supply than demand, it's going to keep going down until finally you can sell what you want to sell. eventually, at some point, it reaches a bottom, and then it starts to reverse. Demand starts growing, and the supply outsupply. But in order to buy low and sell high, you have to buy when no one wants something. So a good example in our real estate private equity, we started buying on a part of town in San Antonio that no one wants. And we started buying in that area at about $11 a square foot. Well, a year and a half later, it's now $47 a square foot because guess what? Lo and behold, people want to start buying in that area. That's how you buy low. Now, when we took investors to this area, it's an older area. It's a safe area, but it's an older area. And there's really nothing going on. Now, 4 years from now, 5 years from now, that's not when you want to be buying. That's when we're going to want to be selling.
And you know what I think it takes?
What?
Well, besides having your goals and knowing what your rate of return needs to be in order to achieve that goals, I see it all the time. And I was listening to another guy talk about finances and how it drives people insane, especially financial experts, when people don't have a goal. And so they say, I just want to make money.
Right.
Well, how much do you need to make? What is your goal? What is your vision?
And what is your methodology?
And what's required to achieve that goal and to achieve that vision? Now, if you're buying an asset that is discounted because it's damaged or it's not attractive, you need to have a vision of where that asset can go in its own market, whether it's real estate. That's a very clear one for me. You're buying a house, and a lot of people don't have that vision of, when we remodeled my backyard together, you were very instrumental in helping me understand what this yard could look like, even though when we first bought it was so overgrown and all this stuff. And so you have to be able to have that vision and do your homework and do your education and have people around you that can offer input to let you know that this is a solid, even though your emotion is saying, I just want to go get that one that's complete and pay full retail for it. Instead of actually making the return on buying something that needs a little bit of work, whether that's a security, whether that's a real estate buy or a car. I mean, whatever you're looking into. I know people who buy and sell cars because they're a mechanic and they can see a car and say, it just needs this, this, and this, and I can make an extra 20% on whatever it is.
Yeah. So there's a lot. There's a lot to building wealth, and we're not going to try and
cover that
simplify
today.
it and just say all you have to do is this. But I could say, in general, just to close on the fundamentals of emotional bias, I can say with reasonable confidence that if you changed your whole process, look for what stinks, what is not being recognized, what people don't want, and develop a buy list out of that list.
Within reason.
Within reason. I mean, I'm speaking very generally now. But if you reversed your methodology, instead of looking at what's hot, what's on the front page, what are you reading about, reverse it to what you're not reading about. What is not being recommended? What is at the bottom of the list? What are the underperformers? What are the sectors, the areas underperforming? Pay attention to that. And from those ashes of bad investments, start developing your watch list. I would say that you would probably be more consistent in your success rate than constantly looking at the best performers. Now, there's money to be made in buying good performing stocks. So.
Well, I think that goes into a lot of the concept of what financial time traveling is, right?
Yes.
Is that we're trying to achieve your goals at a faster rate. In order to do that, you need to have an eye for good investments that will get you there at a faster rate, and understanding that you need to be in the right place at the right time.
Okay.
Like some of the investors in real estate in the Bay Area back in the 90s did amazing.
Right.
If you fast forward it to today, and if you're interested in learning more about the concept of financial time traveling, that's episode 1. The watermark logo that you see in this video is now a hyperlink, so you can click that to subscribe and get back to episode 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. We're on 11, baby.
Wow.
1.
Double
Put them
digit.
next to each other. There's some symmetry there. And I like it. It goes into patterns.
Okay.
Isaiah Berlin, to understand is to perceive patterns. And we're on episode 11, baby. So let's get into the very first emotional bias that we are going to cover today. Now, we see this on the RIA side. Hello, compliance. We just reference Up Capital Management. And we'll put that in the show notes. Sorry about that. Just as a purely informational, this is educational and should not be perceived as advice. Past performance does not guarantee future results, and all the other boilerplate info that we give to you. But clients remember their losses much more vividly than their gains.
Why is that?
Why? I know why. Because it stings.
Yeah, and it hurts.
It stings. It hurts the flesh.
Yeah.
And so sometimes even if they made 70% in the last 4 years, and we talked about this a little bit in the part 1 of this podcast, is that poker players, they remember their losses more than their big wins.
Right.
I mean, we hear that in other industries as well. Why wouldn't it apply here? So what are your experiences with the loss aversion bias?
In poker?
No, in life, in being
in life.
an investment manager.
So I don't know what it is, but the human brain remembers the losses so much more vividly than the
I know
wins.
why. It's because we're wired biologically as a defense mechanism to be able to understand what's a threat to us.
Okay.
And so we
want to
immediately
defend against it.
And that's the negativity bias. And we
Okay.
we'll be covering that in a little bit.
Right.
But it's a piece of the loss aversion tactic is that the negativity bias, let's just jump straight
let's go
into the
down. Let's go,
negativity
yeah.
bias.
Yeah.
Is something that negative news garners more headlines. We see it constantly. And
Yeah.
I would say that that's what the drudgereport.com feeds off of is the negativity bias. And then kind of it depends on who's in office, right? If you're a blue POTUS, then you're going to have negativity bias from the red side. Once we get a red POTUS in there, we're probably going to have a ton of negativity from the blue side.
Right.
And it just feeds into it. And that's why every time we see these counter flip-flops of we need to do something directly
Right.
different,
Right.
and they just move farther. When some natural disaster happens, it's going to get much more headlines. And you said, look at the nightly news, right?
If you just click your clock on watching the 11 o'clock news on how much was negative and then clock that and time it and then clock how much is good news,
Right.
it's almost 90% is all bad news. It shouldn't be
Exactly.
called the nightly news. It should be called the nightly bad news.
Right.
And it has been successful for decades
Mm-hmm.
of producing more negative news, more provocative headlines in the papers, and then even on the internet.
Well, the
what
social
attracts.
media
Right.
echo chamber is an amazing
Right.
place
Right.
for a lot of this negative news to begin.
Loss aversion, which goes hand in hand with the negative bias, is why the success of negative news, it just draws us to it.
And a lot of people who are succumbing to loss aversion, right? They play just super conservatively because they've lost. They got stung by 2008.
Right.
They got stung by the tech bust. They got stung by whatever it is in
Right.
their investments. Maybe they got burned in a pooled portfolio or,
Right,
or maybe an
whatever.
investment group. A
And
friend personally burned
What
them.
they do is they reverse their process. They start getting conservative when they should be growth oriented, and they become growth oriented when they should
Right.
be conservative.
And what's the best way to counteract somebody who's super conservative and hesitant? Is to be ultra aggressive.
Right.
And I see it all the time, like paintballing, for instance. When you
Right.
see the guy who's kind of in the corner and he doesn't want to look too much to give him up, I'm going to run around and rush you.
Right.
Right? And it's the same
Paintball's
way.
a lot of fun.
In football, we see this too, right?
Right.
You were watching a game a couple years ago with my sister. She got a
Right.
full ride to the University of Alabama. Hey,
Little shout out
to
there.
her. She was All-American.
Uh-huh.
Very great athlete.
Full ride, which
but
I'm very happy about.
she didn't play football, which was helpful for
No,
her health.
She played
Oh.
gymnastics.
She did play.
You
Is
played
that how you play
gymnastics? Yeah.
gymnastics? I don't think you play gymnastics. I like to play so hard.
What sport do you play in? I play gymnastics.
So tell us about this story.
Okay,
I
so
want to hear
in
it.
November 2013, November 29th, the Alabama, the Rolling Tide, they're just a dominant powerhouse in football.
Roll Tide roll.
And Nick Saban is a powerhouse coach.
When they're not paying athletes.
Yes, and well, we won't go there. So in 2013, Auburn, their cross-state rival,
Right.
consistently loses to Alabama. They're a smaller school, and this is a fierce rivalry. And in 2013, 2 weeks early, the Auburn Tigers had an amazing win, come back from behind to win.
Okay.
And so now we're set up for the Iron Bowl against Alabama against Auburn, and it's in the closing seconds. The game is tied 28-28, and Alabama drives the ball down to about the 40-yard line for a 50-plus yard field goal attempt. Nick's approach, Nick Saban, was let's go ahead and try to kick it. It probably won't make it. And if it doesn't, we go into overtime. If it does make it, we win the game, right? No brainer.
Easy.
And in flight, the time will go out. So what Nick does is he sets up, out of the 11 players on the field, 8 of them are front linemen.
Okay.
And so of the 11...
You described it like they were in World War II, and these
Yeah.
are the guys who are going to go die in battle.
So he sets it up where he's got basically a defensive team. He's going to be very conservative. He's going to get his field goal kicker to try and kick the ball and win, or not, we go into overtime. So end of strategy. Meanwhile, Auburn does the complete opposite. They're in almost the entire team are their fastest, lightest guys. And as they were setting up, Nick talks about, as he was watching both teams line up, he realized, this is a setup. Because there's hundreds of pounds per player differential, and you can see it on
Probably
the field.
thousands.
Well, total, right?
Yeah.
So the ball gets kicked, it doesn't make it, and their speedster catches the ball in the end zone and runs it all the way back downfield. He only had one person that even came close to touching him, and that was the kicker,
Right.
and that was a no match. And sprints all the way down the sidelines for a touchdown to win 34-28. And as the clock had run out,
Great example of playing conservative, play to safe,
right?
getting attacked by uber aggressive.
And you're talking about arguably one of the best coaches in football,
Right.
Right.
Even
Following Bear
that's a great
Bryant.
point.
Right.
Is that even the best fall
Right.
fall short? Paul Bear Bryant was in coaching in 2015.
He's in that legacy of the
Oh, okay.
Alabama, right?
Yes.
Yeah, amazing coaches in the history of Alabama.
Great hat.
Right.
Great hat.
Yeah.
So let's get into the overconfidence
Yeah,
bias
and
because I think that's
a story.
a great layup into people thinking I have a better skill set than someone else, even though I don't. It's ego related.
Okay.
If you want to read about ego, shameless plug over to Ryan Holiday. He wrote a great book called Ego,
Okay.
I believe. If it's not just ego, there's a couple more words in there. I read it 8 months back. Incredible book
You don't
about
have it on
breaking
your
down the ego.
large stack of
No,
books?
because people keep borrowing my books and they don't bring them back.
You
What
should
books
have
do you have of mine?
I have none.
I need a little check-in,
You need
check-out
You
list.
need a library card.
So it's basically believing that I have an edge that others do not have. And when we come into finance, we don't have a biological part of our brain that's been developed through evolution or however you believe that has helped us learn how to handle our finances. Capitalism is not a part of our human biology. And so it's a skill that we have to learn, we have to be educated about, and to think that someone who spent decades of their life perfecting what they know and you're going to beat them because you were born with a special talent or skill is absolutely ridiculous.
Right.
And a lot of people fundamentally fall for it. And I think it goes into this overinflated self-esteem maybe where everybody gets a trophy.
Yeah. And there is some validity to why one would fall into overconfidence because you've had success. You're doing well.
Oh yeah, it's rational.
And you have a sense of confidence in your decision-making process. So it is there. But where it's really evident is in professional golf because you have a player that wins the Masters, wins the Open.
Okay.
You would think, okay, I've got it. I'm at the top of my game. And next week, I should win again, right? How many professional players win 2, 4, 8 game tournaments in a row? They don't.
Right.
Sometimes they come back and don't even make the cut the next tournament.
A lot of strokes.
So there's a lot of humbling in this world.
I think even Jack Nicklaus had a 12-year streak where he didn't win a single major championship. And Tiger's kind of in that similar spot himself.
Right. And so what professionals recognize is that, yes, I have experience. Yes, I have a better sense of what to do, but it's not going to go to my head. I'm always going to be evaluated. And we talked about SWOT in a couple of episodes, strength, weaknesses, opportunities, and your threats.
Right.
You're always considering your strengths, your weaknesses, your opportunities, and your threats. So out of those 4 words...
It's not SWAT, it's SWAT.
SWAT.
Yes.
Out of those 4 letters, and it's not an acronym.
It is an acronym. It makes a word. Yeah, SWAT.
There we go. Okay, shout out to
The
Nick
Sultan
here.
of SWAT, the
Yeah.
King of Crash.
Yeah, there you go. So 2 of them are positive and 2 of them are negative,
colossal
right?
clout.
Strength and opportunities,
Yes.
and then weaknesses and threats. You're as a professional, you're learning from your mistakes as well as you're learning from your successes.
Right.
But you don't let that be a basis of a bias of overconfidence.
And maybe that could have to do with your familiarity bias. Now, this is interesting stuff because
So we're
when
really jumping all around.
I will
here.
jump
So
where
these-
we jump.
You should see my notes.
This is like Frogger.
All right, go ahead.
So, a lot of these economists that designed how we integrate into the market, especially on the retirement side, as we covered in the part 1 of this, is that they thought that we would make nothing but rational decisions that are the most optimal for us. We're optimizing ourselves at every financial decision that we make, but that's not the case when we introduce a lot of these biases, and that's how inefficiencies in the market develop, such as bubbles, which is not very efficient.
Right.
But the familiarity bias going into maybe someone has done it before when we got
Or
into
has
the
been doing it
overconfidence,
for a long time.
they're familiar with it, and so they only look for information in particular or securities or investments that they're used to.
I guess in familiarity bias, you incorporate your comfort zone.
Or let's say an athlete is training and they only want to use a specific trainer when they keep on losing, but they don't want to switch because they're unfamiliar with it, or people who need to make a big career switch or want to change, but they're too afraid because their comfort zone is limiting them because they're unfamiliar with what's outside of it. It's very natural for us to have a familiarity bias, but when we're investing, and if you're only investing in what you're familiar with,
Yes.
you're exposing yourself open to a lack of diversification because you're not investing in areas that you don't know, which could be fixed income, which could be real estate. All the time we see in the real estate side, right? You have guys who are either 100% in real estate or the other guys who are 100% in equities or just
Something else.
over the
Cash.
Right. And just what your traditional investments are, and especially when you get into endowments or HOAs or single family offices seem more open to it.
Mm-hmm. So this would do a reference to Carol Dweck with her book Mindset, a great book if
Love that
readers
book.
have not read it. But she talks about the growth mindset versus
A static
mindset. And the static is where they're just not looking at outside. And your point that you bring up where you just start focusing on familiarity has actually two liabilities, in my opinion. The first is that you may be missing opportunities because you're staying focused in one area or what you're familiar with.
I hear you.
And number two, like you said about diversification, the point of diversification is that if something's going down, something else may be going up in your portfolio. But if everything is in your familiarity comfort zone, probably you're going to have a higher level of correlation, which you feel good about when everything's going up. But be aware, if everything goes up at the same time, then possibly everything will go down at the same time.
Personal experience, when I first got into my 20s and I had a little bit of play money.
Long ago.
Actually, I didn't have any play money still in my 20s.
Oh,
but
okay.
When I bought my first securities, I was only buying stuff that I was interested in.
Right.
And it was all tech stocks, basically, is what I'm getting at.
Right.
So the first year I was like, oh, I'm up 17%. You guys suck at managing money.
Right. I can do better
Yeah,
than that.
except when it went down, they all went down together. And so that was pretty frustrating. And I learned very quickly that familiarity and kind of the Warren Buffett old adage of buy what you like and you know isn't always the best trick when you're trying to build wealth and sustain wealth and plan it into achieving your goals.
Right.
So it goes back to knowing your goals, knowing your vision, and then being able to understand what rate of return you need to be able to achieve those goals. It's reverse engineering what you need to make it happen, and then setting up your team so that maybe you don't succumb to these biases because you have other people around you. And I'm learning this more so as we grow this business every day by day, and I'm getting other people's opinions that I'm missing, even though I think I should know it. I just missed it because I have other things going on. And then it's like, oh, okay, good call. Really appreciate that. Whether that's, setting up how the call to action is or being able to deliver content that is attractive in a certain way. Just having those outside voices is very helpful when you're trying to get outside of the familiarity bias, or maybe it's paying for a mentor. Maybe it's having people that you particularly choose to give you a counter intuitive view of the world so that you can constantly have an authentic version of the same the same vantage point, different perspective.
So part of familiarity bias is also your resources. What are you reading? If what you're reading, and we talked about this in our previous podcast, but if what you're reading is just what you're familiar with, what you're comfortable with, feeding you the information that you want to read.
Right.
You're basically
Confidence
self-fulfilling. I want to read this article because I'm going to agree with it, and I want to feel good about what I agree with. So that familiarity bias, and I talked about in one of the previous podcasts how I purposely subscribe to resources that I don't agree with, but I want to read it.
If they want this information, they got to click this logo and be able to go back and watch it, okay? Don't give it to them for free. It's around here, all right? Yeah. There's also an invisible monkey that'll eat me if you don't do it.
Pokemon Go.
All right, so getting into, I think going off of the familiarity bias is the projection bias. So when you're looking for people, you might, if you're not looking and you don't have the vision for the group or the team that you need to be able to make the best decisions, a lot of times I see people all the time, especially clients, that project onto you their ideas and you haven't responded in a way that agrees with them, but they walk away and they're like, oh, we're right on the same page. Or advisors all the time that project onto their clients, look, we need to diversify this way, the blah, 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 blah. I have great ideas. I'm convicted in it. And their clients just nod and go, I don't understand what you're saying, sir, but And they leave and the client's like, I have no idea what he just said. Right. I don't know if I even agree with him. And the advisor's like, yep, we had a great meeting. He's totally on board. Let's move forward.
Yeah.
And that's...
You talked about how you can mirror people's mannerisms as
a
a way of getting them to start mirroring you, and then you're in control. Right?
Exactly.
Yeah. Yeah. What did you say? Yeah.
What?
Okay.
That's what these robots are here for.
Yep. So projection bias is where you're either being projected with a particular bias, or you're projecting a bias as well.
What happens when you do this? It leads to a
Yes.
false sense of
Right.
consensus.
Right. So
Speaking of consensus,
Right.
how about census? Let's short it up. The Census Bureau, shameless plug. We just did a cool video, and
Yes.
or actually, we didn't just do it. It was a few weeks ago, and it's on the blog. We're financial time travelers here.
Okay.
All right, it was edited and posted, and it was all about the Census Bureau and what they had to say about income that they post annually. Very interesting stuff.
Right.
So when you have a projection bias, it leads to a consensus that actually isn't real, but in your mind it exists. I don't know if you're going to have personality disorders because of this.
Yeah.
It might be a little factor of narcissism.
Yeah.
Let's go take some selfies and post it on Instagram. What do you say?
So we've got one other here that we want to talk about, and maybe a bonus one if we have time, but the endowment effect. So tell the listeners what we're talking about here with the endowment effect.
So people, it's the theory, and it started in psychology. And it worked its way into the social science that we now know as
Then started in
economics.
biology.
And it basically, it could start at biology. If you want to make an apple pie from scratch, you're going to have to design the universe.
Okay.
That's a quote by Carl Sagan.
Uh-huh.
And so it
What
just
I
goes
also
back.
like, by the
Sorry.
way, you speak of Apple, you had a quote on your whiteboard a couple months ago that I really liked.
I just said
And-
it,
What's that?
that if you want to bake an apple pie, you have to create the universe first.
No, it was
Carl
another
Sagan.
one.
Oh, okay.
where
I
it
do
said-
I do rotate the quotes.
Yes. So, and it said you can look at a tree and count how many apples are in it, but you can't count how many trees are in an apple.
I didn't write that on my whiteboard.
Oh, it must have been someone else.
But I do like it.
That is a good one, though.
Yeah.
Because you don't know how many trees can be created from the seeds that are inside a
Hmm.
single apple.
Unless it's a genetically modified apple, it doesn't have seeds.
Yeah. And then how does
Wow,
it...
wow, wow. Can we get the
Anyways.
zoom in on my face?
Yeah,
Ah!
yeah.
All right, so that goes into the endowment effect where I basically think I have more value, or this is more valuable than it is because I own it, or
Yeah.
it was given to me. Richard Thaler did a
So
cool
you don't
experiment.
think that if something's given to you that you would have less value for it?
It should just be priced at what it's priced at because of the
Oh,
market values
okay.
it there.
All
It
right.
doesn't, just because Nile owns it doesn't mean that it's worth more unless I signed it and took a picture with it. Then it
Yeah.
probably
In
is
10
worth
years,
more. It could be.
It's going to be big bucks.
Big
Here.
bucks.
Hey, can you sign this?
The
for me?
problem with me is that I'm so
Yes.
generous is that I'll
Sign
sign everybody's autograph.
sign this
I
one?
got it.
Okay.
In Sharpie.
Okay. I'm going to... Yeah, could you...
Number 4.
Yeah, there we go.
I got the
you.
cool
Let's hold
Ozzie
this.
Smith baseball you could see in the
I
background.
know, that's awesome.
He puts his Hall of
Another
Fame
great.
number on it. So with him, maybe it's worth more if you're, a Hall of Fame athlete.
Yeah.
But Richard Thaler did a cool experiment. He had his students come in. He gave half of his class a coffee cup that was $6 in the coffee shop.
Okay, all
and then
right.
he didn't give a coffee cup to the other half of the class. And then he asked the class who got the coffee cup, what would you be willing to sell this for? And then asked the other half of the class, what would you be willing to buy it for?
And they all knew it was selling in the coffee shop for $6.
Right.
Okay.
And
all
so
right.
the people who got it for free said, I wouldn't sell this for less than $5.54 or something like that.
Okay,
And then the
all right.
people who knew that they got it for free said, I wouldn't pay more than
wouldn't pay
$2.50
them.
for that. Yeah.
Right.
And so it goes to show that people have an endowment effect where, oh, I got this, so it should be worth more than free.
Right.
It should be $5 or
I'm
whatever.
certainly, because I got it for free, I'm certainly not going to give it away for
Very
free.
interesting.
Yeah.
Absolutely. And so people get into that. I don't want to sell it because I own it, and therefore it should be worth more than whatever it is, which leads into the mental accounting bias, which is another bias that was kind of pioneered by Richard Thaler as well.
Okay.
But various sources of money are different than others. We see this when I first started watching you give these gigantic participant education meetings and encouraging people to roll over their monies into the
Right.
account. Why do you do it?
Right.
Why do you encourage those participants?
Well, there's a lot of reasons, but one of them is
Mostly
that
you're a positive guy.
Yeah, mostly I'm just a very positive guy. But I do that because you need to be efficient with your money. You need to bring it all together. But what's interesting on this mental accounting bias is that you see a lot of times participants who have had a couple of jobs in their career, and you talked in one of our podcasts, one participant came up to you with 9
Yeah.
401k accounts.
They were
had
diversified.
no idea they came up to you and said, "Could you help me find my 401k plan?" And you, it's like Pokemon Go. Let's start looking around for it.
Yes.
You know?
Hold your phone up.
So people are very focused on their current employer's 401k plan that they just started contributing to. They have a high level of bias towards the value of their current
I
because
just made it this week.
right, and they're talking to their colleagues and their fellow employees about their 401k plan. Meanwhile, the accounts that actually worth more with former employers, and maybe you left on less than favorable terms, you don't even want to look at
Right.
that
I
statement.
don't want to call
I
the
don't want to
HR.
remember. Yeah. Especially after my walk-away speech, right? But so there's this bias.
You're
but,
cool, I'm out.
yeah, but the dollar is a dollar. Doesn't matter what 401k plan it's in. It doesn't matter where it is.
Yeah.
And so you need to value all your accounts and value all your dollars equally.
And people don't want to talk. I feel like people are unfamiliar with money. It's this stigma. It's like talking about politics or religion or sex at the coffee table. They don't want to bring it up, especially money. So a lot of people, even if they don't have enough assets for an advisor, they don't want to ask me because they're nervous to talk about it. But it's like, who cares, dude? Let's go get this money that you earned.
Right.
Let's make it back and protect it because
You
what's
didn't want
money?
them to
It's a
give it to you,
resource.
though.
It's a source of power for us to use in service of others and ourselves so that we can live a life that we want to live and enjoy it the way we need to and help others do the same.
Yep.
So that's the mental accounting bias, which
Wow,
wraps up.
This was big.
Yeah.
We covered a lot.
And I would say Richard Thaler identified it in a educational, scholastic way, but people have been, you already knew it without identifying it, but you're telling people bring your money over because I'm noticing a trend where people leave old monies on the table because they're more focused on their $2,000 account that they earned this week
Right.
than maybe the $200,000 they have from a previous employer.
You know what's funny on this
Jokes.
very same point here is that thinking about what you just said, I'll have clients call me and they'll have 100 shares of Disney as an example, and it's a 6-figure, 7-figure account, and they're focused on, by the way, how's my Disney stock doing?
Right.
And it's because it was their selection, and they're paying attention to that. Forget the fact that they have $700,000-$800,000, diversified in other things. How's my Disney stock doing?
Or a lot of them, they have their own play money account, right?
Right.
They'll say, I want 50 grand. I'm going to trade this on my own. You manage the $1 million.
Right.
And then they go, hey, how about them apples?
Yeah, at lunch, so, by the way, I'm up. I had, just a side note, I had a client always at lunch tell me how much better he's doing. And he would never tell me how much money he's managing, but he would constantly remind me how much better he's doing, and he's shorting the VIX and doing all this stuff. And I found out after literally years, I could never get out of him how much it was. Well, I finally found out it was like $10,000.
That's
And
hilarious.
I, of course, always congratulate him on his business acumen and his investing skills. And
Oh, yes.
yes, yeah, very much so.
Very
That's
good.
brilliant that you're doing this.
That's the projection bias right there.
Right. But anyways, so we covered 7. So we have loss aversion.
Yes.
We have overconfidence,
Boom.
mental accountability, familiarity bias, negativity bias, projection bias, and the endowment effect. So this has
Absolutely.
definitely got to be in our show notes because we covered an awful lot.
It's definitely going to be in the show notes. You'll be able to see it on financialtimetraveler.com. You can find us on all the social media channels. This was one of my favorite. We'll probably revisit this at episode 4000.
Yep.
When we've done so many things, we got to revisit it because to remind you guys how powerful this topic is.
Right.
If you want, you can like us. You can subscribe by clicking that link over
Yeah,
there.
how are they going to get more?
There could be a link anywhere in this image right now. It could be anywhere. And I'm pretty sure that if you subscribe, you'll
Yes.
win the lottery in perpetuity for the rest of your life. I can't
Okay.
guarantee it, but it could happen. There's angels in the outfield,
Are
right?
you projecting right now?
No.
Okay.
Me?
All right.
Project?
Right.
All right, that's going to do it for a wrap on episode 11. Excuse me, sir. Or ladies.
Mm-hmm.
Your bias is showing.
Very well done.
Yes, sir. Good
Good
job.
job. Uh-oh.
Once I commit to the pound,
you got to stay with the pound.
because then you're doing this thing.
Yeah.
And then it's-
Rochambeau.
And then you're doing like this, this weird grasp. Anyways,
all right.
that's
that
gonna
was pretty good.
That's gonna
Is
be
this
a wrap.
wrap?
Yeah, we're
Okay,
done.
all right, good.
We've been done. We're working way too hard now.